Welcome everybody to the Corporate Retail Comparative webinar, where Kerry Layton, our economist, is going to be taking you through some of the report. Guys, by all means, please ask questions. I will watch the chat box, and also we will open up for a Q&A at the end. So, guys, Trade Intelligence is a strategic retail intelligence partner. Effectively, we help customers, and that being manufacturers, service providers, retailers, banks, etc., unlock commercial opportunities in the market. So it's really about sort of market understanding the shoppers and how they're behaving in the market, and the channels that are at play. So health and beauty, liquor, e-com, etc. As I said, we look at sort of everything from the shopper and the point of purchase, right up to what's going on in the market and everything in between. How we do that? So there's sort of three portions to the business. The one is syndicated retail research. Corporate Retail Comparative that you're going to see today is one of our original syndicated reports. And obviously the benefit of buying syndicated is that when something is produced for multiple people, the cost of that comes down. We do that, like I said, across shopper, across the channels, across the different retailers, and sort of total market. But then we also do bespoke research where a client might come to us and say, look, you've got this in syndicated, but we really want to double click into our category. And that's where we would do bespoke research for you, generally always looking at the shopper. We typically don't do consumer research. We will do it if it's part of a bigger project, but if it were just sort of consumer, we would send you off to guys who do specifically consumer. Then from an advisory perspective, we do presentations, we run workshops, sort of strategic workshops where we help you to understand the market through the syndicated reports, but really bring that alive in terms of what does that mean in your business? Where are the specific opportunities for you, etc. And then capability building is another arm to our business where basically we upskill people in the market across things like category management, national account management, trade maths. So understanding the financials in the industry, but for people who are sort of non-accountants, and understanding everything from simple things like margin versus markup to a profit and loss statement.
Perfect. Thank you. Yeah, perfect. Thank you so much for that, Kerry. I'm here to present to you the latest corporate retail comparative. And as Kerry was mentioning, it's part of a portfolio across a variety. So corporate retail comparative is one of our 3 sector reports, but we also have market reports, shopper reports, specialist reports, retailer reports, a real deep view into the FMCG space. So this morning's presentation, as I mentioned, is based on the latest report. It's available on our Trade Intelligence portal. The report follows quite a structured process. It starts with an upfront section, then we move into the economic context, then the retailer financials, where we go through it as sort of a financial report. So it's a lot of focus on turnover this morning. We look at profit and operations, and then in the third section, we look at the store footprint. So just a part about how to read this report. So this report covers the 6 retailers. They're color-coded, so it's easy to identify them. So the color coding according to this table. In the middle block, you'll see that Pick n Pay Group has Pick n Pay and Boxer. So they're still together, although Boxer is separately listed. But because the group is the majority shareholder, they is part of the group. And as much as possible, we have separated them into Pick n Pay and Boxer for this analysis. And just a quick reminder of the different trading periods the retailers operate. So when we say financial year FY 2025, you can see what the months look like. And where you see a striped bar, that's to indicate the half-year data. And when we include half-year data, we include the comparable growth. So it's the growth for the same period in the year prior. So as retailers are publishing their data twice a year, and that is the main source of info for this report. That's why we update this report twice a year, and the next update is coming in November. So to sum up and kind of just paint the context, FMCG corporate retail is a dynamic and constantly evolving space, one where profitability faces challenges and is a delicate balancing act. Due to the intense competitive pressure, retailers are fighting for every customer, with promotions accounting for a growing portion of the group sales. So just some context about these 6 retailers. So Shoprite, a star performer. Their supermarket business is over 200 billion rand in 2025. Their extra savings membership program is close to 34 million. Their promotions have ticked up to 40% of their latest turnover. So 40% of their supermarket RSA sales are coming from promotions. This performance is a real far cry from the tough time they had back in 2018, 2019, when they faced system rollout challenges, that strikes, very low internal inflation, and all of that impacted the turnover growth. So star performer now, but they have also had some tough times. So moving over there, we look at the Spar Wholesale Group. They are in deep strategic realignment phase, working to stabilize the business. They've closed off Switzerland and Southwest England, so it's leaving just Spar Ireland and Southern Africa in those numbers there, and they are working hard to improve their retailer loyalty in South Africa. So retailers buying through the Spar Wholesale Group and working hard to get their operating margin back to 3%. So you'll see later on just how much their operating margin has taken a hit. In terms of the Pick n Pay Group, they've made some tough but necessary decisions under Sean Summers, the CEO. In 2025, they successfully had their rights offer and they spun off Boxer, as I mentioned, but they are still the majority shareholder, even after selling off some shares in the last little while. And their focus is on regaining customer loyalty in Pick n Pay and really just leaving Boxer to continue on its solid growth trajectory while still innovating. So, Boxer have launched their B Rewards shopper program. And then in terms of Woolies Food, Woolworths Group, the food business accounts for 65%. Majority of their growth comes from the comparable stores, and their fashion business has been under a lot of pressure. Woolworths Ventures is their new innovative investment, and we're seeing a lot of new formats pop up there, and they did acquire their Absolute Pets, so expanding into pet there. And then for Clicks, it's working towards its medium target of 1,200 stores. Their club card is over 30 years old with 12 million members in the last data update. Interestingly, their turnover growth supported by promotions, and 48% of their turnover in the retail part of Clicks is coming from promotions. Then for Dis-Chem, the group is in the throes of strategic reinvention. They listed back in 2017, and really their focus has been around analytics as well as property. They've launched a new benefits program, which is already delivering some market share gains in their last financials, and they have an expansion plan that's really been ramped up. So that's just to set the context, but who's winning? So a little snapshot here. We've got some of the data and some of the indicators here, ranked turnover, the growth percentages, operating margin. And in this block here is the underlying volume. We've also got some info here on the group store footprint, but this will all make more sense. These numbers will make more sense after the presentation, so we'll have a look at it back then. Okay, so setting the scene with the economic context. Regular readers of the Tatler or the Trade Intelligence monthly economic report will be familiar with some version of the snapshot. So consumer confidence, although still in the red, it had been moving upwards, reaching -7 in Q1, but since plummeting in Q2. Retail sales, so that's total retail, not just FMCG, growth over 2025, but a lot of it coming from durables, so retailers and household goods, for example. But this morning, I'm going to hold myself back and not talk too much about this, but we will look at the inflation data later on when we get to the internal inflation for these retailers. So diving into the financial performance, we start with turnover. So I'm going to spend quite a bit of time on this section because it gives a lot of insight into what's happening below the surface. So in this data, what we have is the group turnover, including all the countries that the groups trade in. So on the chart, how to read it is that on the horizontal axis, you've got the 2025 growth, and up this way, you've got the 2024 growth. So you kind of want to be in that top right-hand corner to have high growth in both periods. So ShopRite Group, which is the red bubble, has had high growth in both. Is the largest turnover as over 250 billion, and the highest growth for both of those periods. When we look at, I'm just going based on size here, so then the next one will be the SPAR Group, the wholesale number. So being under pressure, you can see the growth has been low here, and under pressure since they launched SAP in their KZNDC in February 2023. So it's just been struggling with growth in terms of that. When we look at Pick n Pay, it has had low turnover, weighed down by Pick n Pay, but we'll look more into that later. That's this blue bubble here. For Woolworths Group, the black bubble shows solid growth supported by food. As I mentioned, fashion has been under pressure. And then the health and beauty retailers, Clicks and Dis-Chem, report solid growth and highlighting the attractiveness of this health and beauty segment, in their case underpinned by pharmacy. So Clicks is the light blue bubble, solid growth, but the market has become increasingly competitive. And for Dis-Chem, second highest growth over the period, supported by growth in both retail and the wholesale division. So taking a closer look at performance, so here when we look at taking out the SPAR Ireland portion, you can see the pressure in SPAR Southern Africa there without Ireland. And then when we look at Woolworths, you can see how the food growth, being around 64% of the group's turnover, has really supported. And then the next one I want to show you is Pick n Pay. So what we have here is you can really see how the growth from Boxer has supported that group. Close to 40% of the turnover coming from Boxer, while Pick n Pay showed muted growth. And those numbers include liquor and clothing. And the group has closed a lot of underperforming stores. But later, you'll start to see some of the sort of green shoots coming out of the comparable growth data. All right, so this is one of my favorites. As you can tell, I love graphs. But what we're having a look here is we're trying to zoom in. So this is turnover by brand, looking closely at the grocery retail. Well, trying to. So Pick n Pay Group only break down into Pick n Pay and Boxer. So while the ShopRite data on this graph and SPAR are able to exclude data, Pick n Pay don't. So just bear that in mind. And as I mentioned, the stripe line represents the half-year data. So what we can see here, the red is the ShopRite Group. They continue to expand the USAFE format as a foot in the door into a ShopRite store. When we look at Checkers, including Harper's and 6060, the growth has widened and created this growing gap on Woolworths Food, also including online. And this performance gap has existed for 7 years now due to Checkers expanding footprint. So just in the last 3 years, they've opened up 17 new stores. For SPAR, the green on there represents the SPAR retail performance. So obviously, because that drives the wholesale performance, I wanted to show both. So what you can see there is that the wholesale growth has been lagging, and this is the gap that the group has identified as working to close that retail and loyalty gap. And then for Boxer, another year of high growth, continuing to outpace the sort of other discounted in the format due to those new stores. Okay. All right. Oh, there we go. Online, such a fascinating and fast-moving channel. The reported data is still quite limited here. What we can see is retailers continue to report high online growth percentages, largely driven by on-demand expansion. So the number of on-demand sites has increased to over 2,100 sites. So a big chunk of the footprint covered by that. What we can see is the ShopRite group obviously in the lead, generating just shy of 19 billion in turnover for 2025. High growth, close to 50%. So although 60/60 is available through some ShopRite stores and pet shops, the majority of the turnover is coming through Checkers. For Pick n Pay, they don't report the turnover rands, so the contribution, but you can also see the growth. They have an online portion as well as an on-demand portion. So that's 32.7% includes the 37.6% growth coming from online. And they're delivering from around 620 stores, and they've started rolling out clothing. So seeing opportunity there. And then in terms of Woolworths Food, just shy of 7% of turnover, although I'm very sure they've probably got there in this latest lot of financials. So we estimated around 3.5 billion rand going through for online, because they also have Dash. So Dash is probably close to 75% of the online number, so around 2.6 billion for 2025. And online, also known as digital, or different now to different names, but it continues to see CAPEX investment from retailers as they look to online enhancements. So ShopRite X is the group's digital hub, and Dis-Chem have invested into their X Bigly labs. So having looked at the grocery turnover, there's obviously other parts in the report. So in the main report, there's also liquor, and we've looked at now online. But we want to look at growth composition. So the top of the bar in the solid color is the growth coming from comparable stores, sometimes called like for like. And then the latter, the bottom part of that bar, is growth coming from new or closed stores. So when you add these together, you get the total growth. So that does mean that inflation is included. So ShopRite, supermarkets, RSA, unfortunately, they don't report it at trading brand. So in that number is Checkers, ShopRite, and USave, all lumped together in that number. And then in terms of SPAR, the SPAR retail growth is largely coming from the comparable stores. You can see the decline here, this negative. This is because of store closures. For Pick n Pay, the comparable growth, this is where sort of green shoots come in as we start to look. So they have closed a lot of stores. So that is why for the last few years they have had negative new store growth, and that obviously weighs on total growth. So if we're looking for green shoots, that's probably where we look. And then in terms of Boxer, you can see how the new stores are strategic and they are driving the growth percentage there. For Woolworths, as I mentioned, majority of the growth is coming from the comparable stores. And then when we look at the health and beauty retailers, Clicks and Dis-Chem, they've had solid comparable growth as well as expansion over the last 2 periods at the bottom there. All right, so this is when I get to put on my economist hat. So what about inflation? Because as you know, the inflation is part of that top line growth number. So let's look at the total economy. So based on data from Stats SA, the total CPI is that black line, and it's been relatively contained over 2025. So that's the section over here. Obviously, in 2026, we've seen it jump up, and it's around 5% for June due to the fuel price. The food inflation number is the green line, and I've included personal care there as the yellow line, just as another line there. And although there have been some bubbles due to some meat prices here in the food number, it has generally been moving downward, and most recently it's down to 1.6% for food. So food inflation has been fluctuating. But over the period for 2025, total food inflation was 4.2%. So how do the retailers measure up? So here's the 4.2% and the performance across the retailers. This is self-reported. And the internal selling price inflation, how they calculate is not necessarily published in great detail. So there are some they might not necessarily be consistent, but it is a valuable guideline. In general, it's measured as the year-on-year shift on a dynamic basket. So they may take the basket at the end of the period and compare what was bought versus the price of that basket the year prior, which is different to Stats SA, who have a static basket. So when shoppers make shopping decisions and buy smaller pack sizes or bigger pack sizes or different items, that's not reflected in the Stats SA data, but it would show up in the retailer data. And just in case you were wondering how it would be possible that majority of the retailers would have lower inflation than total inflation. So that is one of the reasons why. And then so retailers remain focused on their price perception to gain or at least retain market share in the very noisy and competitive space. So some of the levers include driving sales in higher margin categories. So in the case of Woolworths, having a more meat in the basket, that can cause for a higher inflation and a stickier inflation. And then in terms of promotional participation or promo mix, as mentioned, 40% of ShopRite supermarkets on sales were on promotion in half year 26 and 48% for Clicks. So these are all the things that play into these numbers. And rewards programs can offer targeted offers. And a lot of this is enabled by systems, technology, and the data within the supply chain. So now that we've seen the internal inflation, this gives us an opportunity to take out the noise. So we talk about underlying volume growth, and what we do is take the comparable growth number and remove the inflation to kind of get a gauge for real performance. So over 2025, as we saw that inflation had moderated, we've also seen store closures. So like in the case of Pick n Pay, they closed unprofitable stores, which supported their comparable growth number. So as mentioned, ShopRite, they don't report a trading brand level. Their underlying volume growth ticked up to 2.5%, and has slowed a little bit in 2026 due to that lower comparable growth number. When we look at SPAR grocery retail, the volume growth is still negative, but it's moving in the right direction. Maybe I'm an optimist. And then Pick n Pay also moving in the right direction, and actually reaching positive 0.9 in 2026. And then for Boxer, continuing the trend and growth there, they had deflation for 2026, which is also supported. So they were the fastest growing in terms of underlying volume. So that's taking out the new stores. That means that in comparable stores, they still managed to get over 5.7% in underlying volume. And then for Woolworths, as I mentioned, the solid comparable growth really helping their volumes there. And then the health and beauty retailers have generally shown resilience. Okay, so this helps with the context as we move into the financial performance part of the profit and operations. So there's a lot in here that I haven't had time to mention. So starting with a little bit of an overview here, we know that gross profit is the difference between the turnover and the cost of sales, and it's impacted by multiple factors. So there's the sales mix across the trading brand, the division, and the category, promotional participation, online participation, what the inflation trend is. And retailers have been focusing on unlocking efficiencies across the supply chain so they can support the price investment to gain or at least retain market share without reducing their gross margin. So some of those levers, just to name a few, would be IT investment into systems and infrastructure, the systems and processes to support better buying and collaboration, targeted promotions, so leveraging your rewards programs, and then the private brand development, just to name a few. So considering all of those elements, what has happened over here is when you take that gross profit rands and you divide it by your turnover, you get a margin, your gross margin. So in the case of the ShopRite group, which is this red one here, at 23.8%, it means that they make 23 Rand 80 in gross profit for every 100 Rand in turnover. So that helps me just kind of keep it into perspective a little bit. And the margin did move slightly lower, indicated by this arrow here. So we're seeing a balancing act considering all of those different things. So they had growth in sort of Checkers and their adjacent businesses like Pet Shop Science and Unique and all of those. So that helped to offset some of that increased pressure coming from that high promotional proportion, where 40% of the turnover was on promotion. When we look at the dark green here, for SPAR SA wholesale, 10.8%. It is a wholesale business, so the margin would be lower. But in 2023, the number was close to 12%, so it has dropped off significantly. For Boxer, the margin here has increased to 21.6%. A lot of it around attributed to things like economies of scale and margin management mix. And it's been able to offset some of the investment into price there in a deflationary environment. And then for Pick n Pay margin, also moving in the right direction at 17%. It does trade lower because mixed in with the Pick n Pay business is their sales to franchisees, which is at a lower margin. And then for Woolworths Food, margin moves slightly lower, attributed to growth in online, as well as expansion in the Midrand DC, adding a bit of cost pressure there. So that's the black one here. And then Clicks margin at 30.7, dropping off slightly due to mix change. So the distribution business, the turnover was higher than the retail business, so that causes a bit of a mix shift. And the same thing happened in Dis-Chem, accounting for that lower margin, where the Dis-Chem wholesale business turnover was ahead of the retail growth. Okay, and then we make our way from gross profit towards operating profits. So accountants look away because I am going to oversimplify and jump around a bit. But what we start with is the alternative revenue, also known as other income. These are things that come from commissions, including the earned through third-party value-added services. So those value-added services generate income, and they also draw card and convenience offering for the customers, for shoppers in the stores. Franchise fees declined for ShopRite and Pick n Pay. Pick n Pay did make some strategic changes to their model, but it did increase for SPAR wholesale. Other things would be lease income, any kind of income. Marketing income has become a growing portion. In the case of ShopRite marketing and media, it increased around 16% to just shy of 600 million Rand, supported by Rainmaker. And then something, so Boxer have monetized their shopper data to suppliers through their Boxer B Inside portal. So all of these things allowing for additional income or alternative revenue streams.
Kerry, there's a question.
Oh, yes. And then in terms of the next step is operating expenses. So a big portion of this is the employee costs. So headcounts increased for ShopRite, Woolworths South Africa, and Clicks. Lower for SPAR wholesale and Dis-Chem. And although Pick n Pay group was unchanged, it was more like the increase in Boxer headcount offsetting declines in Pick n Pay. And there may be changes for 2027 coming from Pick n Pay. Expenses also include any kind of costs associated with occupancy, merchandising, any operational costs in their advertising and marketing. And then a big portion, and a lot of retailers did call this out, is above inflation increases across utilities, which I know we all feel at home as well. So water and electricity. There's also been increases for credit card commissions and security costs. So those are all weighing in there. And that gives us the operating profit. So how does it all balance out? So you've seen there are a lot of moving parts behind that operating margin. So we've seen the shifts in sales mix, the focus on expenses, and the growing alternative revenues. And then the closing of unprofitable stores and geographies and how that all comes in. And then there's a whole lot of mysterious accounting things that also happen before we get to this number. So the arrow along the top here shows how it has changed over the last period. If it's got a cross, if it's got line stripes, it's half year. So what we can see there is slight shift downwards for ShopRite Group, which is pretty common at half year. For Spar, it stayed the same at 2.1, but it's only 1.7 in South Africa. So it did tick up in South Africa, but in 2023 it was 3%. And this is where they're working very hard to get their margin back up to 3% within the South African business. And for Pick n Pay Group, supported by Boxer, so Boxer's trading margin increased to 5.7% from 5.4 in the prior period. So Boxer really supporting this growth here and moving Pick n Pay out of the red over here. And for Woolworths Group, pressure in the fashion business and expense growth weighing on the food margin. So, the setting up for Absolute Pets and some of the online costs, as well as the new initiatives weighing on the margin for Woolworths. Clicks maintain their margin with a very solid retail margin portion. And Dis-Chem's margin dropped, but it was strategic. There was investment into what they call the ecosystem, and they had some non-recurring expenses around the launch of their benefits program. So a lot of moving parts to get to that. And then this is obviously CAPEX, so capital expenditures used to buy, maintain, or improve their fixed assets. I had to look that up so I knew what I was talking about. And the spend is around just shy of 17 billion, so 16.6% across the retailers for 2025. These dotted bars here are the forecasts for 26, and in this case 26 and 27, and how the retailers are planning is really around their strategic focus areas. So new store expansion, maintenance, and IT, data, digital, all of these things around developing the future efficiencies and capacities. So for the 2026 number, it moves up to 18.3 billion. So for ShopRite, 80% of that number is for expansion. The SPAR includes the DC systems that they're embarking on more system changes. For Pick n Pay, 1 billion of the 2.6 is for Boxer. And a portion of about 100 million is for Pick n Pay clothing. For Woolworths, they're spending around 22% of their CAPEX plan for what they call technology and customer. So investments into innovation there, and Clicks targeting their 1,200 stores and 1.3 billion for the next 3 years. Also expanding things like their unique care pharmacy, standalone pharmacy, and for Dis-Chem store expansion, as well as because property is one of their key drivers of their strategic focus areas. They invest heavily in property and invest in their benefits program, and as I mentioned earlier, their ex-Bigly Labs for their data. All right, this leads us nicely into the last section where we're going to look at the store footprint. So in this section, there's a lot of detail. So I'm just going to focus on an overview just on what's happening on the continent. So just over 11,000 stores across these 6 retailers. If you include Spar Ireland and Country Road Group, the number moves to 13,000. So over the last 5 years, they've opened 2,100 net new stores. So more like 1 store per day for the last 5 years, if you were to average it out. Pick and Pay Group obviously remains the most prolific, 36% of the footprint, breaking the 4,000 mark. Spar Southern Africa, 22% of the footprint. Pick and Pay, including Boxer, 20%. And over the last few years, we've seen closures of unprofitable locations. So selected countries in the rest of Africa have been exited. The store estate reset for Pick and Pay has seen some huge shifts in the footprint numbers. Shifts within the group as they move to focus on the core. So, for example, ShopRite Group styling their furniture business to Pepcore, as well as organic growth and acquisitions. So, as I mentioned, Woolworths buying Absolute Pets and Spar acquiring pharmacies. So, lots of changes there. And if we were to add it up and look at it by channel, the retailers are focusing on capturing shoppers' wallets on every shopping occasion. So expanding their reach and trading as multi-formatted and blurred channel operations. So this grocery format driven by discounters growth, thanks to U7 Boxer. They've also opened, you look at the hyper number there, 4 new hypers. Most of them were converted, and the hypers are physically smaller than they have been in the past. In terms of liquor, the liquor growth continues to outpace the grocery format growth. For health and beauty, 44 net new stores just in the latest period, as Clicks and Dis-Chem ramp up their openings, and that is tied very closely to the pharmacy data. Although, in addition, there's also ShopRite Group moving some of their in-store pharmacies to standalone, and Spar changing their opening new pharmacy stores. And then in terms of pet, another very interesting one. Yeah, Absolute Pets joining in, and Checkers with their pet shop science. So this falls part of what I call non-grocery. So when we look at this expansion in non-grocery, the retailers are opening stores in other channels because, as grocery reaches sort of a saturation. So in that yellow bar is everything that's not grocery. So liquor, clothing, pet, bringing in some margin opportunity. So the yellow non-grocery bar overtakes the green, and then that gap has been widening. In the full report, we include details on the grocery footprint, the liquor footprint, pharmacy, forecourts, as well as analysis on trading space, trading density, average turnover per store, a whole lot more information. So we're kind of looking ahead. What is the plan? So ShopRite's planning to open over 300 new stores in 2026, and they're reportedly on track. They're also, as I mentioned, selling more furniture and exiting Ghana and Malawi. So changes happening there. Spar working on their customer loyalty, including, so over and above that pharmacy expansion I mentioned, they've also launched Pet Story. Pick and Pay is wrapping up a major reset, and expansion continues for Pick and Pay clothing as well as Boxer. Woolworths are planning to increase their SA footprint with some new food stores over the next 3 years. Clicks continuing expansion, including pharmacies, so they're on their path to 1,200 stores. And Dis-Chem have already secured licenses for their pharmacy rollout for 2027. And all of this is funded by a big portion of that 18 billion in CAPEX. So who's winning? Now that these numbers have a little bit more context, maybe it's the shopper that's winning. No. And that's me. So do we have any questions?
We don't have any questions in the chat. There's a question. Please, can you show the slide on who's winning again? It was so quick. And then there's also a question on baby. So why the baby channel is declining.
Yeah, very interesting. So in terms of the footprint, that number is only for standalone baby stores. So it doesn't include in-store baby expansion like you will see at a Checkers Hyper, for example. And what's also happened is there a few years ago, Dis-Chem bought out a whole lot of baby city stores, and they have been working through renovating and rebranding and figuring out what is the future of those baby stores, which is also part of why that is declining. Clicks have about 5 or 6 standalone baby stores that they use more as more like a showroom, pushing their online purchases. This came, yeah, but where's the baby portion that is coming through the supermarkets for nappies and consumables is obviously massive, which wouldn't show in a standalone footprint. Yeah, does that answer the question?
I think it does. I see Sam's hand is up. Sam Lutuli, would you like to unmute or?
Yeah, well, hi, please
Hi.
confirm if you can hear me. Hi,
Yes,
Kerry.
we
Hi,
can.
Andrea. Thank you so much. Thank you so much. Just on the promotional trade margin, do you have any insight as to how the retailers are going to improve this dip? I saw Pick n Pay actually saw an improvement in the latest year, but however, ShopRite has actually seen that dip. Do you have any insight on how they're planning to improve that?
So I think it's always going to operate within a band. So that dip for ShopRite is likely just a half-year blip, and it could move back up a little bit higher. Also, it's like 0.2 percentage points. So I'm assuming they have like a targeted range they're looking at. When you look at the number of sort of levers in the background in terms of promotions and private brand and all of those different considerations, and then you look at the number of stores and the number of geographies and the number of trading brands, I imagine it is quite difficult to nail down an exact number while still trying to meet the shoppers where they are in terms of the pressure that the average household is feeling. So I think a lot of the efficiencies are possibly going to come from how they load their trucks in terms of the supply chain to keep those costs of moving goods very low. What else would I want to say about that? Yeah, and then you can see in that how the businesses are so different, how the wholesale portion is significantly lower trading margin, gross margin, whereas ShopRite, or I mean Clicks and Dis-Chem's margins there, that is, we used the total income as an approximation, so we could include the portion that they move between their distribution and their retail channels in there. Yeah, does that make sense?
Clear. Thank you. Very clear.
Perfect.
Thanks.
Thanks, Sam.
So the next question is from Mark from Premier Meat Products. He's asking, is there any geographic trends in the current and new store openings? Are these proportionate to current footprint, or are there new growth hotspots?
Ooh, so in terms of geography, definitely moving closer to home. So Southern African countries performing better than further away, easier to manage in terms of the supply chains. Within South Africa, we don't have a lot of provincial data, which I think is maybe what you're talking about. Yeah, I'm very sure the retailers are doing a lot of focus in terms of, footprint for the future. Yeah.
Yes. So, Kerry, we do have a client I know who works with guys who measure location densities and whatever. And if need be, please mail me. Sorry, I've missed out an L in trade intelligence. And yeah, I will see if I can get the details for you from them.
Right. There's another question from Andre Leroux from Omnicon. What is your prediction around Pick n Pay and Spar growth and performance in the next 12 to 24 months? Gosh, where's that crystal ball, right?
Ooh. Yeah, that's such a great question. I mean, you saw as we went through the presentation, total growth is definitely under pressure. I did pull out those green shoots around comparable growth. So I think the question really is which growth number do you want to look at? Yeah, in terms of total, it's likely going to remain under pressure while those closed stores work their way out of the base. And as that happens, the gap between the comparable growth and the total growth will close a little bit, which then obviously would mean higher total growth as those closed stores work their way out. But I don't know. I don't
So
want to make
maybe anecdotally, we do have clients who say that they're starting to see green shoots in Pick n Pay. Obviously, we report on stuff that is audited, shared, etc. Anecdotal stuff we would share in a presentation, sort of, yeah, or in a client meeting. But like I say, we do have clients who are saying they're starting to see green shoots within Pick n Pay. There are concerns about SPAR. That said, the guys at SPAR are doing a lot of work in the background, also with change in leadership, to improve things drastically and looking at different channels, options, etc., because to some extent SPAR is hampered versus the other retailers. So if, for example, you look at that underlying volume growth number and the fact that Boxer and Shoprite's numbers are largely being driven by new stores, that's obviously where SPAR struggles, because they don't have the ability to open up stores or kind of throw money at the problem and open up new stores where they want to because of the voluntary trading model. So yeah, I think, as Kerry says, it's very, very tough out there. SPAR, I think, is going to take a little bit longer, but Pick n Pay, certainly people say they are starting to see green shoots. That said, the last 2 months apparently have been very tough. Yeah, in Pick n Pay and in Clicks, interestingly.
Yeah, and that's also showing in the retail sales numbers from Stats SA, which is a fast-moving index where we can sort of see it. So a muted performance across the general dealers and the food specialists actually in red, coming from that Stats SA data of the last 2 months. Yeah.
Thanks, Kerry. The next question from Jackie Hans van Rensburg. She's asking about there's currently a significant push towards private label brands. Do we see this trend continuing in the future? Additionally, what's the perspective on retailers' private label growth strategies in the long term? Role these brands are expected to play within the overall category portfolio. So it really is about where's the focus for private label going forward, and also from a category perspective.
Sure. So we do have a private label report, private brand report. Yeah. Do you have a view, Andrea?
I do, but I'll share at the end. But yeah, please continue.
Yeah. So in there, it's SPAR are definitely pushing to increase their private brand participation in terms of their sales into the retailers. Shoprite have mentioned in past presentations that they don't have a target. They use their private brand more as to fill a gap in the market. So that's sort of their official messaging in terms of private brand. Yeah, Andrea, let's hear from you.
I think basically, I mean, the retailers include the focus on private brands in their strategy. So it's definitely something they intend to grow. There appears to be room for growth, sadly, for the brands that are needing to protect their space on shelf and their market share. And like Kerry mentioned now, some retailers actually call out that they look for category opportunities. So if we look at the trends on private brands over the past few years, you know, looking at the tiering of private brands, not only the affordable alternative, but a good, better, best, and even expanding into premium offerings. So from a category perspective, we definitely see widening beyond the commodities and home cleaning products into everything from personal care to daily offerings.
Absolutely. And if
There's
you're
some
looking at
comments
the
here from
chat,
Verlene.
yeah, great reply from Verlene. Thank you.
Jackie, also just bear in mind, we actually are looking at potentially doing a hardware/DIY report next year because we've got a couple of clients asking. So like I say, syndicated, an example this year is pet, where we actually had a number of clients asking about pet. We were going to do sort of a bespoke report, but we actually had so many clients asking about pet that we ended up doing a category report in pet this year. We're currently scoping and looking at whether we do a hardware one. So I think we'll reach out to Alison's Wares, who actually used to be a client of ours when she was at Spa. So we'll pick that up.
I don't see any further questions, but I would love to mention there was a question about the content of this presentation. So as you would have seen, you're most welcome to purchase the Corporate Retail Comparative Report. Also very exciting news is obviously ShopRite will be presenting their full year results on the 1st of September, and then Woolworths on the 2nd of September. And after a while, we get the complete sort of financial results. So Kerry Layton will obviously include those updates that are really important in the November update. So as you would have seen in the message, if you purchase this report, there's a complimentary update coming up in November. Some of you on the call are also within businesses that already buy this report. So please check in with your team if that's on the list of trade intelligence reports that you already have. So we can open access by giving you the login details. Otherwise, if you haven't purchased it, please feel free to contact us. Right, if there aren't any further questions, I would love to invite you, if you haven't already, to snap that QR code. We would love to hear from you. So please share your feedback. It's a very quick and easy survey. Thank you so much, Kerry, for sharing those insights. I mean, it's such a fiercely competitive landscape. And you mentioned something really interesting, who's winning. Interesting to look at how shoppers are benefiting from the fierce competition between these retailers. I mean, there's a shop around every corner and all the retailers are competing on deals. But yeah, that's definitely impacting the industry. So it will be interesting to see how things unfold going forward, like I said, with some important retailer results coming up later this year. Right, so I think that wraps it up. Thank you so much, everyone, for your time, and you know how to reach us. If you have any questions, feel free to contact us. Thanks so much. Have a good day.
Thanks.